All right. How's everybody doing? As I already said, my name is Bob Iacchino. If you don't know who I am, that's okay. I've been doing this almost 30 years now, been involved in markets, started my career in futures, but we're not here to talk about me. We're here to talk about the US election season, specifically the presidential election that is going on exactly 9 days from now. And there are outcomes from this election that could affect what's going on in the overall markets and could influence the futures markets, especially in the short term, especially in the overnight session. So before I begin with any information at all, I just want to read this disclaimer at the bottom. By the way, neither one of these pictures on here are of me, as you could see. I probably look like a cross between the two of them, but I'm going to read this disclaimer. Trading in futures and options carries substantial risk of loss and is not suitable for every investor. Past results are no indication of future performance. Information provided in this webinar is intended solely for informational purposes only. The opinions expressed in this webinar are not necessarily the opinions of Plus 500 US. That last part, I think, probably one of the more important parts. These are my opinions. I've traded through several presidential elections. This one, of course, being one of the more, let's call it cantankerous ones. So because there's a lot of emotion swirling around this election, number one, I'm going to cover no geopolitics. That's the first thing. And number two, I'm going to refer to them as candidate A and candidate B. Okay, just so that you guys don't hear any sort of preference in my voice, so that we can just be talking about what I believe the market effects or the different outcomes could possibly be. So first, let's talk about where we are with current market conditions. As I said, no geopolitics will be covered, but we're talking through this particular episode as why elections matter for markets and especially for retail traders. So let's talk about current market conditions. We are currently in a bull market for stocks, a bull market for gold, a bear market for treasuries, meaning prices lower, yields higher. Keep that in mind. A bear market consolidation in crude oil. Why do I call it that? Crude oil consolidates in these wide price bands. It trends in one direction or the other, but then it consolidates for periods of time where the market kind of feels that the supply and demand dynamics of crude oil are pretty much balanced. Now, that balance can be within an $8 to $10 range, but we're in one of those right now. And the reason I call it a bear market consolidation is the consolidation we're in has a slight downward bend to it. And you'll see that in crude oil quite a bit as well. We're in a weak bull market in copper. We're in a bull market in the dollar, and the FOMC is in easing mode. So we're going to cover policies for economic growth between the two candidates and specifically how they affect inflation in the US, tax policy, regulatory structure, trade policy, stimulus, and both candidates' approach to monetary policy. So let's start with economic policy and inflation. I'm going to kind of go back and forth on these. Okay, so candidate A, well, you can see the picture below. I'm going to leave names out for now, is a drill baby drill candidate. What does that mean? Well, candidate A plans on unleashing the full power of the fossil fuel sector in the US. Okay, so what does that mean for inflation? Well, it likely means lower energy prices, but not right away. A lot of people think that when you unleash the sort of regulatory environment, which I say below, he plans on reducing regulations, that oil is just going to come out of the market. And it doesn't work that way. I wrote a piece about a year and a half ago about how, especially with shale drilling, you're talking about 18 to 24 months or 36 months if you haven't started the leasing process for oil to actually come on the market once you've discovered a deposit. Candidate B, on the other hand, plans on making government-financed investments in clean energy. Now, that could potentially mean some new jobs, but it most likely means higher energy prices because currently clean energy is not efficient enough to produce a lower cost of energy without subsidies. So we'll call that mildly inflationary. I mentioned candidate A is going to reduce regulations. That's on a broad swath of issues, not just energy. And also, he wants to cut corporate taxes. So, what does that do for inflation? Well, a corporate tax cut could theoretically lower inflation because corporations paying less taxes could, in theory, lower prices and benefit the consumer. That's likely to be a very long story. In other words, it'll have to be one or two that lower their prices first, and then the rest will lower prices to follow in order to not get lost in terms of market share. But that's not going to happen right away. And plus, cutting corporate taxes, as a lot of these things do, rely on Congress as well. And then encourage the reshoring of manufacturing. That's likely to be more of a carrot and stick game. In other words, we'll give you tax breaks if you bring your manufacturing into the US, and we'll also give you subsidies and other things like that. We'll favor your companies if you do that. Candidate B is talking about givebacks, okay? $50,000 startup deductions for small business owners, another $6,000 in tax credits, child tax credits for new parents, $25,000 down payment assistance for first-time home buyers. Let me take the last one first. In my experience, you saw this with electric vehicles. The minute that the government is going to give you money back for buying a certain product, in this case, it would be houses, first-time home buyers, the price automatically goes up by that amount. So that just in and of itself is likely deflationary for real estate. Child tax credit, always good. I've got no problem with that. That's likely to just ease the burden on consumers. The $50,000 startup deduction for small business owners, it's a deduction. And because of that, the business has to be started and making money before they get that money back. So that's not likely to be a very effective policy. So we'll call that neutral in terms of inflation and deflation. Okay. Let's talk about tax policy. Candidate A, corporate tax cuts, which we also talked about in the last slide. Candidate B, tax cuts for 100 million Americans at the bottom. Let me skip down to candidate A, the second part, tax cuts for most individuals, because that applies to the top line under candidate B. Tax cut for 100 million Americans. In relation to corporate tax cuts for candidate B, it's actually the opposite. Candidate B wants to raise corporate taxes, assuming that that will fill coffers. In many studies, when you raise taxes, you actually, over 2 to 3 years, reduce the amount of money coming into the government because the economy shrinks, because corporations are spending less money. Subsequently, they're hiring fewer people and overall GDP shrinks. And when GDP shrinks, tax receipts shrink. Tax cuts for most individuals, along with tax cuts for 100 million Americans at the bottom, both of those are good, okay? But both of those will probably be slightly inflationary. Now, you hear a lot of rhetoric about candidate A cutting taxes for the rich. We go back to his candidacy, or I should say his presidency from 2016. There was a New York Times article in 2019 that was titled, "Face It, You Probably Got a Tax Cut," acknowledging that about 93 to 94% of Americans received a tax cut with his last tax plan. And the reason I bring that up is because that's expiring in 2025. So both of these candidates can say they're going to do this, but if they don't renew the 2025 tax cuts that happened in 2017, that'll be offset with whatever cuts they make. So it's likely there could be no tax cut at all. So we have to keep that in mind. No tax on tips, no tax on overtime for candidate A. I like both of those. They're likely inflationary, okay, because that's more spending money. And American consumers spend money. I need to mention something to you guys that I forgot to mention at the start of this. Down at the bottom, you see a tab for this GoToWebinar. If you are coming in from a non-English speaking country, there's a translation tab that you can hit on there. Okay, so you hit captions and then you hit your particular language. I should have said that in the beginning and I apologize for that. Slipped my mind as I was getting excited about talking about these topics. But if you could go down there and hit that, if you're from a non-English speaking country and you want to get the translation into your own language, it will do that. Hopefully you understood when I said that. I want to go back to candidate B here. Possible taxes levied on unrealized capital gains. And that's for people with 100 million net worth and above. So that's a disastrous policy economically. It's deflationary. It's not just disinflationary, it's deflationary because it slows the economy quite abruptly. It leaves, at this point, people with 100 million net worth and above, it leaves them with the absolute requirement to sell assets in order to satisfy tax debt under that particular policy. And I'll say this about that as well. Once a policy is passed, one of two things happens in the United States. Either inflation pushes all of us above that 100 million net worth threshold because of our homes, our businesses, and things like that, or they start lowering it to take in more money. So it's just, in my opinion, it's a bad idea on its face. If you have to sell an asset just to pay the taxes on the unrealized capital gains, that means there's no more gain. And therefore, you don't accumulate more wealth and you don't hire people and you don't spend money. So in and of itself, it is deflationary. No tax on tip, no tax on overtime, both inflationary. Let's talk about regulatory structure. Candidate A has an emphasis on deregulation, particularly in energy and finance. He did a lot of finance deregulation in his first term, a little bit of energy, plans on doing more. The idea is to spur business activity and economic freedom. This is, again, likely short-term inflationary, okay? And I keep bringing up inflation for this reason. Actually, we'll talk about it later on in the presentation. But remember that I keep bringing up inflation. Candidate B, specifics are less detailed. Her approach is likely going to be to continue or expand the current administration's policies, okay? And that is climate goals and consumer protections. That means more regulations, and that is deflationary because, again, it's short-term disinflationary because it puts hurdles up in front of businesses who want to hire more people and produce more GDP. Now, again, because we're in a high inflation regime right now, depending on which particular metric you look at, US inflation is about 2.6 to 3%. So we're well above the Fed's target anyway. And because inflation has a 20% head start on wages, candidate B's policy kind of might be better for the overall consumer, but it's not better for economic growth. And there's a part I'm going to talk about with that as well. And that's essentially called the productivity miracle. So I'll talk about that in a minute. Trade policy. Candidate A is a protectionist candidate. I don't say that as a bad word. I say it as a fact, okay? Including high tariffs aimed at protecting U.S. industries and renegotiating trade deals for better terms. Underneath that, I put take candidate A seriously, but not literally. I stole that from somebody named James Fishbeck, who is the chief investment officer at Azoria Capital. I like that he said that because candidate A is his reputation is as a deal maker. And as we go into the actual election, he's thrown out various numbers of the size of tariffs, including 100 to 200%. That is likely nowhere near where tariffs will end up, if they even end up with tariffs at all. There was one particular instance in his first term where he threatened a country with tariffs if they didn't comply with a certain request. They didn't comply. He slapped the tariffs on. They decided to comply, and he took the tariffs off. Okay, so when you look at the tariffs from 2016 to 2019, they were not inflationary. There were periodic blips in things he put tariffs on that then leveled off with the rest of the price dynamics. But also, he was in a very low inflationary regime to begin with. Candidate B, multilateral approach focusing on sustainability, labor rights, climate change, and possibly reducing tariffs through specifics on her trade policy are scant. There's not a lot of details about what she would do with trade policy, but you can assume that they wouldn't move much from where they are now, which is likely deflationary. okay, which likely means lower inflation in the future. Remember, when I'm saying deflationary, I'm not saying it as a good thing or a bad thing, I'm saying it as a factual thing. If the economy slows down, the increases in prices that Americans have suffered through will slow down as well. Let's look at consumer stimulus. Candidate A, tax cuts and deregulation. It's more the same, right? Candidate B, give backs and possible cost controls. Tax cuts, deregulation, likely inflationary. Okay, they just are. Now, you would hope the corporate tax cuts would allow corporations to pay people more, and this way the inflation that's already in the system would get eaten by wage growth. Cannot promise that'll happen because corporations get to do whatever they want to do with that, unless, of course, they're fighting a labor union like Boeing is right now. Candidate B, give backs and possible cost controls. What do I mean by give backs? $6,000 additional child tax credits, $50,000 for new business startups, $25,000 for new home buyers. Those on their face are inflationary. The inflation that the US suffered through 2021, 2022 is because of stimulus checks. And these are some more of the same. So that's inflationary. Candidate A, inflationary policies as well, but they could result in higher productivity. And the only way to beat inflation without driving the economy lower and possibly into a recession is through productivity. That means people are making more goods and services in a shorter amount of time for the same pay or marginally higher pay. And if they do that, prices don't have to go up and corporations can still be more and more profitable as each year goes on. Their stock prices go up, they're happy, and inflation slowly comes down. But it's a phase two kind of a thing. So if the first thing that candidate A does is tax cuts and deregulations, it's inflationary in the beginning. That's what's going to matter to retail traders because it'll drive the direction of some of the commodities and futures prices and sectors we should look at. Let's look at interest rate policy. Candidate A, a preference for lower rates and looser monetary policy to support business growth. That's going to be a very tough one, okay? I expect candidate A, if he wins, to put a lot of pressure on the Federal Reserve. And I expect the Federal Reserve to not respond to that pressure at all. They've already cut 50 basis points. I'm talking about the US Federal Reserve, the FOMC. I've already cut 50 basis points at a time where I personally believe they shouldn't have. But I also believe they're going to again because I think the data in the economy right now is too strong for that. But it's not my job, it's theirs. But he's going to pressure them to lower rates and keep rates low in order to help home buyers because he's not part of the givebacks community that candidate B is in. My issue with this is that with all the other policies being slightly inflationary, longer term rates, meaning the 10-year yield, the 30-year yield, which are the two that control interest rates, mortgages on homes the most, are going to rise. So when we look at something like housing, it's going to be a struggle if candidate A wins for those prices to come down, okay? He's expecting a productivity miracle to fend off inflation. That's what he's expecting. And it is possible. It's happened before, but it will not be a first 6-month activity, in my opinion. Won't be something that happens in the very beginning. Candidate B, no explicit policy stance on monetary policy. The assumption can be made that the policy stance is simply that the Fed is independent. I have to commend candidate B when her and her team are asked a question about where they stand in terms of Fed policy. They basically say the Fed is independent and the Fed is going to make their decisions based on what they think. Now, taking us all out of fantasy land for a second, president appoints the Fed chair. The president appoints Fed board members, which then get approved by Congress. The Secretary of the Treasury meets with the Fed president very regularly. My guess is that the Treasury Secretary tells the chairman of the Fed, the chairperson of the Fed, I should say, what the White House's opinion is. So I really am going to assume both of them will put pressure on the Fed to try and keep rates as low as possible. And that in and of itself is likely inflationary, given the current market dynamics that we talked about on the very first slide. Possible strengths, and by this I mean bullish moves, okay? This is where it matters to you. And this is in the short term, okay? So this is 2 weeks after the election, first 14 days. Possible areas of strength, the energy sector, crude oil, natural gas. Why would that be a strength? Well, it would be a strength because you cannot turn the spigots on. And the first thing that's going to happen is there's going to be spending in that sector, okay? And also the relationship that candidate A has built up with some of the oil producing nations in the Middle East is stronger than candidate B. But initially, the energy sector will likely fall. So crude oil prices, to a certain degree, natural gas prices, they will probably fall initially. Candidate B, renewable energy and clean technology, copper. That means copper. Okay, a little bit silver, some nickel, aluminum, but it means copper, it means platinum, it means palladium. Those are going to be strong metals, or might be strong metals, I should say, if candidate B were to win. Remember, these are all my opinion. These are just examples of what can happen based off of the amount of elections I've seen. Candidate A, defense and aerospace, is likely to be a strong sector because he's very big on space travel. He's very big on defense. Candidate B, infrastructure. Again, that's copper. Okay, copper and metals are likely to have a bid behind them. Same thing with candidate A, infrastructure and construction in general. So you could tell that I'm already kind of saying that copper and metals are likely to have a decent tailwind behind them, regardless of who wins. Candidate A, small business, that means hiring, that means wages may rise. So that's going to be kind of one of the things you're going to look at in terms of the inflationary implications. Candidate B, healthcare, nothing really to look at there in the futures markets, maybe in the stock market. Same thing with pharmaceuticals, but tech, okay? Candidate A will likely be stronger in materials and mining and consumer discretionary, while candidate B is going to be stronger in tech. So what does that mean? Candidate A likely has a stronger tailwind in the S&P. Candidate B likely has a stronger tailwind in the NASDAQ. Here's the other thing, though. Possible weaknesses. Renewable energy and clean technology for candidate A, and the energy sector for candidate B. Candidate B, these again are initial reactions by markets, in my opinion. I fully expect if candidate B were to win, that the Middle East would begin pumping as much oil as they could. So that ends up being deflationary. I'm not sure that would happen with candidate A. Infrastructure for candidate A, healthcare for candidate A, pharmaceuticals and tech, banking could be a weakness. This all has to do with sort of the interest rate environment that he's likely to try and pressure sort of into existence. And candidate B, small business is going to be weak. Construction will likely be weak. Materials and mining may not be that great. Candidate B has huge pressure from environmental groups. So any materials, minings, and things like that would be trouble. And consumer discretionary is not likely to do well in the stock market either. So let's talk about general observations. And this is kind of where the rubber hits the road for us as futures traders. Let me just go left, all the ones on the left here and all the ones on the right, instead of going back and forth. For candidate A, inflation and interest rates, there's a consensus that his policies could lead to higher inflation due to tariffs and increased deficits, potentially affecting sectors sensitive to interest rates and consumer spending. That, I think, is entirely true. But I think it's going to be more of a shorter term phenomenon because there will be added productivity. Market sentiment. I believe we're seeing market sentiment already. Candidate A seems to be in the lead in some of the polls and in the betting markets. And I believe that candidate A is part of what's driving equity markets to new all-time highs at the same time that gold is going to new all-time highs. And I'll talk about that in a second. Global trade, sectors reliant on international trade could face challenges. That, again, is copper. If you're talking about a country like China, who's the #1 user of copper, you could see weakness in the Chinese economy due to that protectionist or nationalist policy that underlies his trade policies. So you could see weakness out of China to India to a certain degree, which could hurt raw materials like copper and the like. Immigration policy, that's a wild card, really, for both sides. Because if there really is a mass deportation, it's going to be highly, highly, highly inflationary in the short term. Let's go to candidate B. Tax policy impact. Tax increases on higher income brackets and changes to capital gains could affect these high income earners, potentially reducing disposable income. And that's why luxury goods likely won't do well initially if candidate B wins. And that's also why you're likely to see equities sell off a little bit, but I'll talk about that in a minute. Consumer spending is likely to fall. The regulatory environment is likely to get worse, especially looking at ESG. That, of course, is environmental, social governance, and DEI, diversity, equity, and inclusion policies that restrain businesses from doing what they believe is best. So that restrains hiring and it restrains productivity. Candidate A is relying on a productivity miracle, while candidate B doesn't seem to think that it's necessary, but both could have, over the medium term, a disinflationary effect. And market sentiment for candidate B, the anticipation of these policies could lead to volatility in markets, especially in sectors directly impacted by policy changes. Investors might pull out of industries perceived as losing favor under her administration. That, to me, is likely where the larger equity market sell-off would come from. So when we're looking at futures, right, which is what we talk about here, candidate A, I think stock indexes will go higher initially. When he won in 2016, overnight they went lower, and then by morning they were going higher, and the cash markets almost exclusively went higher. Then I think they'll go higher still. One of the things that this particular candidate doesn't get enough credit for is extending the bull market at the end of the 8-year bull market when President Obama left office. That's difficult to do. So that was because of deregulation and tax cuts. So that could happen again, but in the midst of a stronger economy, which is why I think it's inflationary. People tell you, hey, his trade policy is inflationary. I think his economic policy is inflationary because the overall economy isn't that bad yet. Interest rates. Oh, under stock indices, I have higher, then lower. That's because of the inflationary sort of boost I think his presidency is going to give, and then a Fed aggressively hiking rates again. And then you're going to see a lot of clashes and a lot of problems. Interest rates, not likely a first 100-day issues, but longer-term interest rates will likely rise while the candidate puts pressure on the Fed to put short-term rates lower. This is not going to help the housing market, in my opinion. Energy higher than lower, higher at first, but then lower down the road as U.S. producers ramp back up. If you look at what's been happening with crude oil, rig counts have been coming down for about 2.5 years, and now we're starting to see U.S. production fall off as well. Industrial metals higher and gold higher. You're going to notice something on these two slides. Going to B, stock indices lower. I think initially there will be a stock sell-off if candidate B wins. My opinion, okay, I think it may be a dip to buy, but I think initially that's how the market's going to react. Interest rates will likely head lower because, again, I think this particular docket of policies represents a slower economy. Energy lower than higher. Why lower? Lower demand for energy. So just like candidate A, energy is going to head higher first because there's going to be this perception of a spark in the economy with the deregulation and tax cuts. Candidate B is likely going to continue this sort of prediction of lower and lower demand globally, but then higher because this particular candidate is not likely to support more fossil fuels. And gold higher. Why do I think gold is higher for both candidates? Because both candidates are spenders. Now, maybe candidate A is going to do something different than he did in 2016, 17, 18. Maybe candidate B is going to do something different than they did the past 3.5 years. But both candidates spent a lot, and I'm talking about not including COVID. This particular administration has the highest debt to GDP ratio in history that did not include a war or a pandemic. And there's nothing out there that I see that shows that candidate A will be any different, except the possibility for higher tax receipts from this productivity miracle that will take at least a couple of quarters, if not years, to play out. So this is the particular slide that I think you want to look at. What we think markets will do. At the end of the day, elections matter for markets and retail traders because elections results matter in the short term. So you should have an idea of what you think these candidates represent and what their policies will represent. But on top of that, it's important to note that the majority of what I list in this presentation needs Congress. So that might actually be the more important election results to watch, because without Congress, deregulation is possible. Additional regulations are possible. A little bit of change at the border is possible, but otherwise the rest of it, you need Congress. So outcomes are going to depend almost completely on both the executive branch and legislative branch being in the same party. There's a couple of chances of that for this particular election. That's something to draw on. And then lastly, over the long term, the S&P 500 has shown an average gain of about 3.1% 3 months after a presidential election, regardless of the winner, with a 65% chance of being higher by the end of that period. Over 6 months, the average return is an increase of 5.4%, with a 70% probability of the market being higher during that time frame. Now, this is when I have to bring us back to the disclaimer that I read at the very beginning. Past performance does not mean that's going to happen again. Okay, it doesn't mean it. This is just showing what's happened over the last bunch of presidential elections. So if you think about the psychology behind that, why would that be? It would be because if an incumbent gets reelected, it's likely because the populace believes that things are going well and they want them to continue to go well, so they're optimistic, or because they think things are going bad, and if the new party comes into power, they think it's a change, so they're optimistic. Either way, it lends itself to optimism. But notice I said a 65% chance and a 70% chance, not 100. So be very careful to go back to one of the first pages in this presentation where I talked about the types of markets we're in right now and where that may end up when we're done here, as to whether we're in that kind of regime still or not. All right, so that's kind of the most important thing. I don't know if we have a place here for questions. I'm not sure if we do. I'm looking for a chat box here. Yeah, I don't know if we do in this particular setting, but I would like to talk to you guys a little bit more. So if there's any other way you guys can get me questions, if you're a customer of Plus500, if you have questions, I'm sure they can just sort of put them together for me and I'd be happy to answer them. I just found a Q&A. Oh, here's one. Yeah. So there is a place for questions in here. So, but you guys can also reach out to Plus500. You guys should sign up for Plus500 anyway. I mean, it's one of the first things I open in the morning, because even if you're not trading live regularly like I am, they have unlimited free live data on demo, and it's live data. It's not delayed. That to me is a very, very big deal. Thank you guys for being here, and I will see you on the next episode that we do. Cheers, guys.